This morning, the Bank of Canada got tough. They announced a 1% increase to the overnight lending rate, whereas the market for the last couple of weeks had been pricing in already a very aggressive 0.75 increase. So what does today's announcement mean? How will it impact your mortgage? Join me as we discuss further. Inflation is like that unwanted guest that just doesn't go away. It is persistent and not fading. And this, of course, is being driven by external factors. In the Bank of Canada's press release, they cited the conflict in Ukraine as the number one driving factor. And it's becoming embedded in the economy. And what that means, what the problem is that if we as consumers believe that inflation will be persistent, then we will change our spending habits today, being fearful that tomorrow things will be more expensive. And what does that do? That drives up demand, and that's not good. So the Bank of Canada is trying to get into the consumer's head. They're trying to change our habits, how you and I spend money. And how do they do that? Well, by surprising us all with a 1% increase to the prime rate, whereas the market expected a 75 basis point increase. And that is unprecedented. We haven't seen that since 1998. So what does a 1% increase to the prime rate actually mean for your mortgage? Per $100,000 of mortgage debt that you have, you can expect to see approximately a $50 per month increase to your mortgage payment. And so this is going to get tight. This is going to be very concerning for many variable rate mortgage holders, myself included. So what is the guidance going forward? Do we endure this for long? It's been one increase after another, one shock after another that is bucking all expectations in terms of where rates are going. But I'm going to hypothesize here with you that we are perhaps getting close to an inflection point, because there are conflicting forces that act on mortgage rates. And when we say mortgage rates, we have to distinguish between fixed rates and variable rates. Fixed rate mortgages are determined by bond yields or treasury yields in the US. And we are starting to see the reversal of the yield curve driving fixed rates down. And we actually are already seeing that in the US. Here in Canada, just this week, some lenders started to drop fixed rate mortgages. So it's not that all mortgage rates are going up. Fixed rates are starting to come down. Why are they coming down? Because we are starting to anticipate, the market is anticipating the arrival of a recession. So that's something that we should be paying attention to and keeping an eye on as we go forward. On the flip side, the Bank of Canada is very clearly communicating, talking very tough on inflation, that they will continue to raise the prime rate. And that may be. We may still see further increases to the prime rate in September and the latter half of this year. But is that a reason to jump ship and convert from variable to fixed? I don't believe so, because history tells us over the last 30 years, there have been 6 rate hike cycles by the Bank of Canada, similar to this one. This is the 7th one. And each of those rate hike cycles that we've seen resulted in a recession and a very precipitous, very definite drop of the prime rate to previous lows. And so if we are looking at what is developing now, this is a classic situation: rising inflation, rising demand in the economy. This will eventually run out of steam and a recession will be hit. It's almost designed to do this. And the Bank of Canada is okay putting the Canadian economy into a recession, because recession is better than inflation. So look out for this story. I do believe that within the next 6 months, as we reach 2023, relief will be on its way. But what do you do in the meantime? If you're very concerned about your mortgage payment, I invite you to reach out. It's also a great time to actually sit down and do a household budget. The whole idea of raising the policy rate and prime rate is so that we don't spend as much money. So as a household, maybe it's time to come up with a budget, sit down, and determine what your monthly expenses are, what can be cut out, and help to lower the demand and lower inflation. My name is Chris Mulder. I'm a Toronto mortgage broker. As always, the door is open to you. If you have any questions or concerns about today's announcement, feel free to reach out. I've included a link to my calendar below. Have a great summer until September.